Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome once again to your Tax-Free Life podcast. As always, I'm excited to be here with each and every one of you every single week. This is actually episode number 80, and this is a continuation, actually part 3, of understanding your financial paradigms in retirement. And there are many of them. I think we're doing a 7-part series in which we are covering a number of issues and concerns that are going to be very critical for each and every one of you, each and every one of us, as we start to prepare for retirement. Always remember that retirement is a journey. It's not just arriving at a given point and then deciding what to do next. Most important, the more preparation that you do prior to retirement, the better off and the better your life will be when it comes to your retirement life, your retirement distribution choices, and how it is you manage your life accordingly once you get to the top of the mountain or the summit and you start coming down throughout your retirement years. Today's episode, again, number 80, and for those of you that may be listening to us for the first time, as always, we appreciate if you can go ahead and sign up with us so you can continue to receive your podcast notification on a weekly basis, and you can continue to enjoy the type of information and education that we provide on each and every one of these topics as we move forward every single week. Today's topic is going to be retirement distribution planning, and this is one of the areas that we spend a lot of time on with our clients because it is very critical that they understand how retirement distribution planning works, and most important, what are the issues, what are the concerns, what are the choices they need to make and or address when it comes to your retirement distribution. Always remember that when you go from accumulating assets to the distribution of assets, the rules of engagement totally change. And you hear me say those words in just about every podcast because I think it's quite apropos that all of us that are thinking about retirement truly understand that it is a totally different ballgame when you stop working, and now instead of you working for your money, now your money is working for you. So one of the first things that I want to cover today is the difference between the old paradigm of retirement thinking versus a new paradigm when it comes to retirement distribution planning. See, the old paradigm used to say that, you would be living on less money in retirement, you would be in a lower tax bracket, and due to the fact that you would be in a lower tax bracket, then obviously tax-deferred investments like IRAs, 401ks, other types of qualified retirement plans and or pensions were actually and I underline the word the best vehicles and investments for your retirement. Now the new paradigm, is totally different than the old paradigm. The new paradigm, and this is based on empirical evidence we see every single day, you'll need as much money in retirement as you do today. And one of the challenges that we have with many of our clients when we have conversations about the amount of money that they're going to need in retirement, I always get the same thing. Well, you know what, Bert, my mortgage is going to be paid for by the time I get to the age of retirement, age 65. So therefore, I'm going to need less money in order to make ends meet. In reality, yes, you may not have a mortgage payment, but you will have an expense liability, because many times what you will find is that the money that you were spending toward your mortgage will now go towards something else like health care and many other issues that you will find along the way once you retirement. The other issue is that government fiscal challenges will more than likely push taxes to a higher level. And many economists and scientists, when it comes to political inclinations and economic inclinations, will actually state that, if taxes do not double in the United States in the next several years, then there's a very high probability that our country's going to go bankrupt because the government is not going to be able to support all of the debt, all of the liability, and all of those promises that our government has made to the American people that they don't have the money today in order to meet. You may also find yourself in a higher tax bracket because a lot of the deductions, exemptions, and credits that you were able to take while you were employed would actually go away at the point in time that you retire. While you're in employment and while you're accumulating assets, if you have children, if you're married, filing jointly, and you have children, you're able to take certain deductions and credits for your children. If you're making contributions to an IRA or a 401k, you obviously get to deduct that off of your taxes. If you're making mortgage payments, the interest on those payments are also tax deductible to you on a given year. So you may find that once you get to retirement, many of those things have actually gone away, and you're not going to be able to take a tax deduction. So even if taxes were not to go higher in the future, which I highly doubt that's not going to be the case, your personal tax liability may be higher because of the fact that you're not going to be able to deduct some of the things that you had been deducting for many, many years. So that brings us to another point that is very critical under the new paradigm, and that is that accumulating the right amount of assets in the right buckets may actually extend your retirement life in the foreseeable future and for many, many years to come. Now, you heard me talk about the right kind of buckets and the three buckets, three financial buckets, and the three tax buckets that I talk about in just about every podcast. And the reason why I continue to mention these things is that the vast majority of Americans truly do not understand not only what those buckets are and what they represent, but they don't even know how they get taxed, and they don't even know how much money you should have in each and every one of those taxable buckets under the IRS code. So for those of you that have been listening to our podcast for almost 2 years, you guys are at the top 1% of the food chain, because most of you have a very clear understanding of how to make money decisions based on the taxable buckets that I will be discussing in the next few seconds. Now, as you know, there are three tax buckets. You have your taxable bucket, you have your tax-deferred bucket, and then last but not least would be your tax-free bucket. Now, the taxable bucket is primarily your taxable accounts, and these are accounts that are very, very liquid from a business standpoint. So all of us need to have money in the taxable bucket, but by the same token, due to the fact that every single dollar in that bucket is going to be taxed, then you have to be very careful as to how much money you keep in that bucket. Now, what are some of the vehicles that would fit into the taxable bucket? Well, your savings accounts, your CDs, your checking accounts, your money market accounts. If you have traditional mutual funds in that bucket, that would also fit there as well. And the reason why they call it the taxable bucket is the money that goes into that bucket has already paid taxes. Every single year as the money grows in that bucket, you will be receiving a 1099 from the financial institution where you invested your money with, and that's going to be reportable for tax purposes. And if you happen to invest in a mutual fund and then you decide to sell your portfolio at a given point in time in the future, not only did the money that you put in was after tax and the growth of that money was taxable and reportable every single year, but then upon the sale of that mutual fund portfolio, then obviously there's going to be an additional tax which may include ordinary income taxes, dividend income taxes, and hopefully capital gains taxes along those lines. So you need to have the right amount of money in the taxable bucket. Normally, we recommend no more than 6 months of expenses in that bucket, which is something very, very critical for all of us to have, because life happens and things happen. So if you have an emergency, then you should have the proper amounts, so you don't have to liquidate assets at the wrong time in order to meet a given emergency. Now, can you keep a little bit more than that? I guess you could, more than 6 months if there's a need for that. So if you say, Bert, I'm going to be purchasing a property, I'm going to have some liquidity available because I have an eye on a couple of properties that I want to purchase or acquire from a business perspective, okay, that would be fine. Just bear in mind that the more money that you have in your taxable bucket, the higher the tax liability for you every single year will be. Now, the second bucket is one that is most understood by Americans, and that is the tax-deferred bucket. In this tax-deferred bucket, the money that goes in is pre-tax. The money grows tax-deferred, but then when you pull the money out, you have to pay taxes on the whole thing. What are some of the vehicles that fit in the tax-deferred bucket? Well, IRAs, 401ks, SEPs, 403bs, pensions, anything that you can defer taxes on today will fit in the tax-deferred bucket. Annuities will also factor into the tax-deferred bucket, whether they happen to be qualified annuities or non-qualified annuities, meaning with invested with pre-tax dollars or after-tax dollars. The challenge with the tax-deferred bucket is that yes, you're deferring the taxes, but by the same token, not only are you deferring the taxes, you're also deferring the tax liability. And if taxes are going to be a lot greater in the future than they are today, then obviously you have to have just the right amount of money in your tax-deferred vehicle, not to exceed your standard deductions credit that you get every single year when you file your income taxes. And I'll mention that in the next few minutes as well, and I'll go into a little bit more detail. So most of the time, depending on your tax bracket, depending on your age, you may not have more than $450,000 to $500,000 in the tax-deferred bucket, because if you have a lot more than that and you get to age 70 and a half, when you now have to start taking required minimum distributions, then the required minimum distribution out of that bucket may actually be detrimental to your tax liability when it comes to your Social Security benefits and also your Medicare premium in retirement. So you have to be very careful when it comes to the amount of assets that you not only have in the taxable bucket, but also the tax-deferred bucket. Now, the last bucket that we'll talk about today will be the tax-free bucket. And anything that does not fit in the taxable bucket or the tax-deferred bucket should go in the tax-free bucket. It is probably the best bucket out of all three, and it is also the least understood bucket under the IRS code. What are some of the vehicles that fit in the tax-free bucket? Well, Roth IRAs, Roth 401ks, municipal bonds with an asterisk, because although municipal bonds are received federal income tax free, the calculation is a negative calculation for provisional income calculation, which will ultimately determine what percentage, if any, of your Social Security benefits will be taxed in retirement. Municipal bonds require you to take the amount of distribution from a municipal bond fund or a municipal bond and add it on to that provisional income calculation that may hinder the proper distribution of your Social Security benefits. So that's why municipal bonds, although they fit inside the tax-free bucket, I do have it there with an asterisk because it's not totally tax exempt. And then the last vehicle that fits into the tax-free bucket are 7702 plans, which are the cash value life insurance plans that enjoy tremendous tax benefits under the IRS code. So any monies that you have in IRAs or Roth IRAs, Roth 401ks and 7702 plans inside the tax-free bucket will not have a negative impact on the distribution of your Social Security benefits. So you want to have as much of your money as you possibly can inside these tax-free vehicles in correlation to your tax-free bucket in order to minimize and or eliminate your tax liabilities in retirement. Now, one of the major challenges that we all have when it comes to the compounding effect of taxes in retirement is that, the vast majority of Americans keep most of their money either in the taxable bucket or the tax-deferred bucket. So what happens is, especially in the tax-deferred bucket, your money compounds, but so does your tax liability. So I think the question for most of you on this podcast today would be, what would you prefer? Would you prefer compound interest or compound taxed? Now, every single time that I ask that question of any of our tax planning clients, the answer is always the same. Well, Bert, I would like to have or enjoy the benefits of having compound interest, but I would want to have simple tax. So in a perfect world, you would want to have the ability to have that compound interest and the simple tax. The challenge is that unless you do proper tax planning, in just about every bucket that you're going to have, except for the tax-free bucket. Therefore, if you have money in your taxable bucket and you have money in the tax-deferred bucket, then as your money compounds, so does your tax liability. But if you do proper tax planning, you're going to be able, and you and your family will have the ability to compound that interest, but also maintaining the tax at a simple level, so you don't allow the taxes to compound from one year to the next. And it takes proper tax planning in order for you and your family to be able to accomplish that. So, that's one of the areas that we spend a lot of time in when we do tax planning for our clients. Now, finally, I want to discuss a little bit about the challenges of the required minimum distributions, which we call RMDs, when you get to the age of 70 and a half. You see, whenever you put money into any type of deferred account, in this case, let's say IRAs and 401ks and qualified annuities and pensions and 403bs and supplemental retirement plans that may be qualified in nature or qualified deferred compensation programs, the IRS places certain limitations on you. So if you take money out of these plans prior to the age of 59 and a half, unless you have the ability to borrow through a 401k structure or so forth, then you may find yourself, or unless you meet certain exigent circumstances, you will find yourself that you're going to have to pay taxes on the distribution plus an additional 10% penalty for early distributions under the IRS code. So between the ages of 59 and a half and 70 and a half, you can pretty much do anything you want with your tax deferred accounts or the tax deferred bucket. You can leave the money there, you can pull all the money out at one point in time, or you can take some money out 1 year and not take any money out the following year. And then obviously whenever you take the money out, you'll pay taxes on the amount that you take out, but you don't pay any type of penalties like you would have had if you take money out prior to age 59 and a half. Now, when you get to 70 and a half, the rules of engagement now totally change, because now the IRS is going to hit you with an excise tax, which is an excise penalty tax of 50%. And yes, you heard me right. I always say the same thing, 50%. So that means that when you get to age 70 and a half, if you're supposed to take $10,000 out of your account and you don't, not only are you going to be liable for the taxes of that $10,000 that you should have taken but you didn't, but on top of that, the IRS is going to hit you with a $5,000 or a 50% excise tax on that distribution. So therefore, if you happen to be in the 20% tax bracket, you would have paid out of the $10,000 of distribution that you should have taken that you didn't. The IRS is going to give you a $5,000 penalty on that distribution, and then you'll pay 20% on the $10,000. So that would be another $2,000. So 70 cents or 70% of that distribution will actually go to taxes and penalty, and you will only net 30%. So it is extremely important that you understand the rules of engagement once you get to the age of 70 and a half. Now, the 70 and a half rules, there are a number of rules that are associated with that. Number one, during your first year of distribution, so let's say that you turn 70 and a half in 2019, the IRS gives you a couple of choices a first year of distribution. Choice number one, they allow you to take the 2019 distribution in 2019 because you hit 70 and a half in this current year, or you can wait until April 1st of 2020 in order to take the 2019 distribution. Now, the decision whether to take that distribution in 2019 or 2020 requires some tax forward planning that most accountants don't have the ability to do. But if you're dealing with somebody or someone that happens to be a tax planner, they'll have the proper software to determine whether it makes more sense for you to take your required minimum distributions in 2019 because it is the time that you hit the age of 70 and a half, or does it make more sense to wait until 2020 from a business perspective? One of the critical things to remember is that if you delay the 2019 distribution because you turned 70 and a half this year, and you want to wait until April 1st of 2020 in order to take that 2019 distribution, then in 2020 you will be forced basically by the IRS code to take two distributions in 2020. That means that you will take the 2019 by April 1st of 2020 and report that for income tax purposes in your 2020 tax return. And then by December 31st of 2020, the IRS requires you to take your 2020 distribution as well. So, and it will also be reportable in your 2020 tax year. So you have to be very careful, because unless you do proper tax planning, you are going to be adding two distributions for tax purposes in one given year. And then every year thereafter, you are required to take your required minimum distributions, or RMDs, by December 31st of every given year. Now, you have to be very careful as you take these distributions, because these distributions could have a negative impact on the taxation of your Social Security benefits. And if you don't do it the right way, your Social Security benefits may be taxable. So it may be you may have a liability up to 50% of your Social Security benefits from a taxable perspective. And many times you may have a liability up to 85% of your Social Security benefits. So you have to be very careful, and also be aware that the taxation of your tax deferred accounts do not just impact the tax liability on that distribution from that account, but it also has a negative impact on the Social Security calculations that are called provisional income calculations when you do retire, and those may definitely hinder the effectiveness and the efficiency of your Social Security benefits in retirement. Also be aware that in the first year that you hit 70 and a half, your required minimum distribution will be 3.65% of whatever the account value was in the previous year. So if you turned 70 and a half in 2019, you would have to look back to December 31st of 2018 and identify the total value of all your IRAs and your 401ks and other qualified plans in order to determine that number, and then times that 3.65% will give you the minimum amount of money that you must distribute out of your accounts in order to meet your required minimum distributions and avoid that 50% penalty. So again, one of the things that we do for many of our clients when it comes to retirement distribution planning and tax planning is just to make certain that you take at least the minimum RMD every year, but most important, that you don't waste away your standard deduction. So let me give you an example, and with this I will close the podcast for today. Let's say that you turn 2019, or that you turn 70 and a half in 2019. That means that you would have to go back to December 31st of 2018 and get the last statement that you get from the financial institutions out of all your qualified accounts like IRAs and 401ks, etc., in order to determine the minimum distribution under RMD rules. Let's say that at the end of 2018, the value of all of these accounts equals $500,000 or $500,000. So now you take 500,000 times 3.65%, and that will give you a distribution of $18,250 that you can either take as an RMD in 2019, or you could delay taking that money until April 1st, no later than April 1st of 2020. The challenge is if you have no other deductions, then you just wasted away a portion of your standard deduction. And the reason for that is that, standard deduction, if you happen to be married filing jointly for 2018, was $24,000, but your IRA distribution requirement was $18,250. You see, if you have your distribution required under your RMDs underneath your standard deduction, now you can have your cake and eat it too. That means that if you make contributions to an IRA, 401k, 403b, or the like, then the money that you put in was pre-tax, the money grew tax deferred, and because now you've done proper tax planning, now you have the ability to take that distribution, those $18,250 in 2019 or by April 1st of 2020, and not have to pay a single dollar of federal income tax on those amounts, because of the fact that your standard deduction of $24,000 actually offsetted the potential tax liability of those $18,250 or RMDs. So now the question is, well, if you were able to take $18,250 of RMD and you're still below the $24,000 of standard deduction, why would you want to let that go to waste? What you should do is take up to $24,000 of those RMDs, because you can always take more. You cannot take less than the $18,250, but you can take more, and then bring it up to that $24,000 off standard deduction, so that way you're taking that money out of these qualified accounts without having to pay any federal income taxes on those distributions. What can you do with the additional money? Well, you can save it. You can, put it away and pay some bills, some additional bills that otherwise you would have to use taxable dollars to do that with. You can do a Roth conversion, so now you get the best of all worlds, because not only did you put the money in pre-tax and the money grew tax deferred, and then you pulled it out tax free due to the standard deduction offset, but now you also have the ability to do a conversion, put the money into a Roth IRA, and now that money is going to grow tax-free once again for the rest of your life. So again, unless you do proper tax planning, then you may very well be paying more in taxes every single year than you really need to. For those of you that are joining us for the first time, now you're starting to understand that retirement is a journey, and the decisions that you need to make in retirement, and the decisions that all of us need to prepare for prior to reaching the golden years of retirement are obviously things that are very critical, that are very important to make certain that you're doing the right things and taking the right steps at the right time in order to make certain that you can enjoy a wonderful tax-free life in retirement, like the name of our podcast is, and that you can also maximize a benefit not only for yourselves, but also for your families as well. And as always, one final thought, always remember that if you need to reach out to me to discuss anything, not only in this podcast, but every other podcast that we've done, feel free to do so. You can reach out to me at area code 786-766-1042. Also, don't forget to subscribe to our podcast channel so you can get the updates on a regular basis. And most important, you can also email me at Bert, B-E-R-T, at GablesTaxGroup.com. Again, always remember that my number one goal and that of my firm is to kind of help all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time. I hope all of you enjoyed your 4th of July weekend that we just went through, and that you had a great time with family and friends. And I look forward to speaking to you again next week. Take care. Have a great day. Bye-bye.